Welcome to the Broken Pie Chart Podcast, episode 296. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of Zega Financial, Jay Pestrichelli. Jay, what's going on?
Derek, we had a little pullback in the market this week. A couple days it tried to press higher, but a little bit of a breather in the markets. I would say, volatility pushed a little higher, VVIX higher. Like, I don't know, maybe we're going to start to, get the volatility that precedes every election finally, right? By the way, not that we're sitting here waiting for it to happen. There's no strategy we're running on that one, but it feels like it's a little overdue. So I think we're due, what we felt here, the little tiniest of shakeup this week is probably, really well prescribed and foreseen. So we shall see what next week brings. Next week, is it the last full week before the Big E?
Before the election? I believe it is, yeah.
Yeah, I think it's coming. So, one more year for people to one more week for people to do a little rebalance and get themselves positioned, I guess. Some people do that. Or what are you doing?
Aren't I selling everything and hiding under a rock? I don't know. By the way, it's been a while since I wrote not a long form article, but I've got that data where I went back 102 years. I looked at the different returns based upon, is it all Republican, all Democrat? I may put out an article next week with some of those graphs. I think
it feels like that's the time to do it. Maybe people will keep a level head and not make an emotional decision.
Yeah, well, this is why you hedge. But I mean, don't you think, though, I feel like, so the momentum is definitely in Trump's favor if you read the pundits, and they're worth whatever they're worth. But, he's surging, and some of the polls, I think didn't you read an article, was that in Bloomberg this week? There's kind of different industries now, like, is it the Trump trade or is it the Harris trade? Are you starting to see that?
Yeah, I mean, it's you start to look at certain industries that, may be affected, right? Like, with healthcare, that probably, gets, some benefit under Harris. And then you look at maybe, electric, although maybe the recent alignment with Elon Musk might not be as severe, but, he said day one, he's going to cut, EV subsidies. So maybe that industry has problems. And then you could look at oil and gas might do better under Trump. So I think we're starting to see where the pieces are falling. I did see that. And I will tell you, I didn't realize this, that maybe the financials end up being in a little worse scenario under Harris, because there's some legislation where they want to raise capital requirements on financial institutions, whereas Trump, that's not nearly as important. I hadn't picked that one up until I read that article. So, yeah, it just seems like, people are starting to pick their positions and starting to watch what each one of those sectors are going to do based on who's going to win. I did hear Charles Payne from Fox Business, actual former friend of ours while we were at Ameritrade, and also had me on early when I released my book over at Fox Business. Charles said, watch the small caps as a potential indicator of, Trump will be more favorable to the small caps. I'm not sure if I buy into that one, but, watch those as kind of the barometer of how the market is positioning for a Trump victory. I don't know. A lot of theories out there. You know what I feel like can tell you with a lot of certainty is whatever people think is not what they think is going to happen is not what is going to happen. So just, watch for the reaction to be shocking, I would imagine.
Well, or was the market not happy this week because Goldman Sachs came out and said their base case is 3% annualized returns over the next 10 years?
Yeah, I mean, that was a pretty bold statement. Not bold in a like we're going to buck the trend here and tell you the market's not going to do what it's done for the last, 40 years, 50 years on average, 30 years. And you should expect, low returns. I don't know where they're coming up with that info. I think you've done a little research on that, but it's one of those things that if they're right, they look smart. If they're wrong, everybody made money and it's okay anyway.
I don't know why they just didn't do the whole What's the long-term average? 8%. Like, oh yeah, our base case is 8%. Our base case is 8%.
Well, I think they came out to say a baseline of 3 is far away from 8.
Yeah, but -1 to 7. I'm joking because it always seems like they give the average, but we very rarely get the average. But now, so let me go into this a little bit. So Goldman Sachs came out and they said next 10 years, so 2024 to the end of 2034, a range of -1 annualized, which would put you on par with the lost decade of the 2000s, up to baseline of 3, so -1 to 7. And the reason why they did that, so there was a lot of headlines on this. I saw it on CNBC, saw it all over online. I went and I found the 30-something page report, Jay, as you know I would. And here's why they did what they did. Their baseline includes concentration. So they looked at market concentration. And their footnotes here have it surged to multi-decade highs. If you exclude the concentration variable in their model, their base case goes to 7% return. And anywhere from 3 to 11. So 7 with 3 and 11. And they cited a couple of things. Market concentration, the 1-year forward volatility. I guess the higher the market concentration, we are in the 10th percentile, I believe. So they're saying, more volatility. And they also did a study where you looked at market concentration defined as the market cap of the largest stock relative to the 75th percentile stock. And they've got an XY scatter plot, and the XY scatters show higher concentration, the forwards. That it looks like, without repeating all 37 pages, that's kind of the genesis of this.
So because we're so concentrated right now, they feel like that it's kind of the law of large numbers, right? It's harder for big companies to add an extra trillion of market cap. It's easier for smaller companies to kind of add and grow. And so when you're concentrated, the projected growth of those in combination is probably a little less. I mean, is that the theory there?
Maybe, although I would say 10 years ago, NVIDIA wasn't in one of the biggest companies. And now
I know. No, I know. Like I'm
but the volatility piece, it makes sense because if you have more concentration in fewer names, we know that from the diversification standpoint, the textbook thing is once you get to about 27 symbols, that's your optimal sort of diversification. It's the law of diminishing returns. So, if you have less theoretical diversification, you're going to have more volatility because those names will less name. You know what I'm saying? I don't even.
Yep. Yeah. No. Of course. All right.
The other thing, so Bespoke put something on Twitter. I don't know if they put it on or somebody else put it on. It doesn't matter. It's from them. And they stated, this week Goldman Sachs research department made headlines by forecasting blah, blah, blah. We already went through that. And they said 3% total returns are in the bottom decile of historical U.S. equity returns. And you have to look at, basically, you go back to the 30s, you go like 73 through 79, and then it looks like, the GFC, kind of the rolling 10-year returns. It's very rare.
By GFC, you mean the 08-09 great financial crisis?
Correct. So, and by the way, it's not just Goldman. So Vanguard, I think this was from June, the end of June. So in fairness, I don't know what their target is now. But, Vanguard, I think they had U.S. equities at like 2.7 to 5.2 over the next 10 years. 3.2 to 5.2. Interestingly enough, they had AGG, their estimate 4.5 to 5.5 over the next 10 years. That's from June 30th, to be fair to Vanguard, but I found those.
Okay. Yeah.
So basically they're saying you should own according to, I'm not saying
you should own bonds instead of stocks.
Yeah, just own AGG because you can get 4.5 to 5.5 annualized versus 3.2 to 5.2. Okay. Well, do you remember this? I wrote the article. It was at the end of 2020. At the end of 2019, and I did the returns by decade. And there was the same stuff. Remember this? It was like, we might only have 2% annualized. Like,
how did we do? Didn't we double in 3 years?
Yeah, not great.
Yeah,
Not great.
We did really great. The prediction was not great.
So I don't know. I mean, this gets headlines, but I feel like they always do this. Like if you go back 5 years, they probably said the same thing. Back in 2013, they probably said the same thing. It's like, I don't know. You got nothing?
Hard to know. I wish I could say so. I unfortunately agree with what you're saying. I think this is, like I said, this seems like a strange prediction, bold prediction. It could happen. Derek, I remember, I'll go to another piece where we were looking at, was it the Schiller was like predicting the average over the next 10 years.
Oh, you want to get me wound up? Start talking about the Cape-Shiller ratio. Let's do it. Come on.
I don't want to get too wound up. I just want to say, like, that. And look, did he win a Nobel Prize for that work? Right? Like,
so did the guys who bankrupted long-term capital management, didn't they?
Yeah. So so the smartest research, and by the way, we are definitely doing much, much better than that, right? We're up 20+% this year. What were we up last year? 20%, 25% last year. Like, that shouldn't happen if those numbers by these, very well recognized academic, and I'll say very smart people, if that had come through. It's just so hard. And I'm not saying they're wrong all the time. I guess I'm saying they can be wrong, like anybody could be wrong, because things change. All things being equal, well, guess what? They're never always the equal.
No.
Yeah, fine. This Goldman Sachs data looks like, wow, look at those data points that they're giving us. Maybe 3% is the number we're going to get over the next 10 years. But things are so different. They change so rapidly. Nobody really talked about the most obvious thing to bring up is AI, but also crypto hadn't made its way in there too. Like, you think about all of these things that are potentially moving markets, things change. Things will change. There's no way those models predict what the changes will be that we have coming up. I got asked at a conference the other day, what's going to be the thing that causes us to go down, to go into a bear market from here? I said, it's something you haven't thought of, because if you thought of it already, it's been priced in, right? This is the same thing on the upside. What's going to cause us to surprise to the upside? It's stuff that we haven't seen before that adds to profitability and adds to corporate profits and adds to, forward-looking growth.
I'll add to your comment at the conference. In 2006, 2005, we knew housing was overvalued. The question is, how broke could you be betting against it until it actually came true? You got to get the timing right too. You got to be right and get the timing. So, yeah. All right, I'll take the bear case on this, and I'll say a lot of people look at where we are right now. I think we're 22.7 times forward PE. And when you think about from 1 year to the next, or from 1 year to 10 years later, what's responsible for the returns? Well, you can have an increase in the multiple. You can have an increase in the EPS, or the earnings. You could have an increase or decrease. Obviously, all these are increases, decrease in net profit margins, in revenue, in buybacks, and dividends. Like, that's really, when you want to explain how you got from one period to the next, you can explain it like, what was the attribution? So people look at this right now and they say, well, margins are really high. The forward PE is 22.7. It's not 16. So if I'm taking the bear case, I'm saying, well, how much more multiple expansion can we get? So at this point, you can't. Okay, let me rephrase that. It's not that we can't get multiple expansion. We're not, going from 16 to 22 is a heck of a lot easier than going from 22.7 to 25. Sure, it can happen. We're really relying at this point, not on the multiple, more on the earnings.
Earnings growth.
Revenue, and it's the net margins. Now, people are like, oh, margins are going to revert to the mean. I'm not sure about that, because these are different type of companies. But, that's, if I want to take the bear case, I'll do that. But, tell me what the margins are going to be. All right. Tell me what the revenue is going to be.
Well, we showed that last week. Margins and revenue look up. The earnings look higher. Wasn't that the PE ratio we talked about last week? We talked about that. Yeah. Maybe that's an article I'll write too. I'll write a long form on explaining how, giving the example of, like, here's your revenue, here's your margin. You play around with these different things and you figure out, you can explain where market's going to go. All right. Another thing we should talk about is, I noticed that people are surprised
by the rise in 10-year yields post-Fed increase. And so it was 3.7 was the 10-year rate on September 18th. Recently, it's almost to 4.3. So that's roughly, what is that? Like 55 basis points?
I was going to say, 0.5%. Yep.
Yeah, roughly there. Okay. So I saw somebody on CNBC saying this is unprecedented, never happened before. And you know me, I'm like, I think it's happened before. And
it's absolutely happened before. We talked about it multiple times. You've showed me data multiple times on this.
That's right. And I'm sure the audience can guess where I'm going to go. Can you imagine what time period this actually happened? Okay. 1995.
Was it 94, 95? I didn't know.
July 6th, rates were 6.05 on July 6th when the Fed did their first rate cut. I believe they went to 6.6, which is 55 basis points higher, before they actually fell, and then they went up again. They wound up being a full 1 percentage point higher than they were. So no, it's not unprecedented. It went up, but people are like, "Oh my God, yields are going up." So it's happened before.
Yep, I think. Look, it's I love that you fact check the folks that you see on TV, but you already knew before you had to fact check.
I already knew. I didn't even need to. I remember. I lived it. I was in the markets. I remember people being like,
So what are you saying? We could expect with more cuts, higher rates in the 10-year?
Well, who's wrong? So here's the other thing. We said this a long time ago, and I'm glad people are talking about the spread between the 10-year Treasury yield and the 30-year mortgage. And right now, the 30-year mortgage is about 6.54, according to Federal Reserve Bank of St. Louis, the fine folks there. And what are we, 4.25 right now? So what is that? That's like 230 basis points spread. Historically, that's closer. If I find the episode, it was a couple of months ago we talked about this. I'll link to it. But that's closer to the long-term average, about 170 basis points. The question is, maybe the 30-year mortgage rate has it right. Maybe the 10-year is going to come up. And eventually, the 10-year has to be more like, 4.8, 4.9, 5. I don't know. Like, who's right here?
Yeah. No, we don't know who's right.
Of course.
But I will tell you that mortgage companies have to get it right, or they have to be more conservative, right? So if they're willing to come down on rates, it's only because they're being pressed to do it. They would obviously leave rates higher if they can. And I think they have left them high considering everything that's happening in the Treasury market. So look, to me, it feels like the fact they're coming down, Derek, tells me they're like being pressed to do it. Right. So, because competition, and that's what the market is mandating.
But are they coming? I don't think they're coming down.
Well, from a year ago, they're coming down.
Well, sure. No, they are. Yeah.
So they're coming down from a year ago, but in the short term, they obviously move them around. They're quick to move them up, a little slower to move them down. It's like almost like gas prices versus oil, right? You've probably seen that too. So I don't know. To me, it's encouraging to be under the 7 mark on mortgage. What did you say the rate was?
6.54 according to the St. Louis Fed.
Yeah, that's good. That should spur some help. Although I think we got to get under 6 to really kick in, and maybe naturally that is just on the way. Why it's not there yet, I don't know. To your point, because maybe they know they're not going down, and this is just temporary.
So the New York Fed put out it's kind of I guess we'll call it a paper. And this was, when did I see this? I had it say, only I would save this for future reference. But one of the charts, and you can see this, is the mortgage spread fitted values. And they basically, on the x-axis, they looked at the yield curve slope. On the y-axis, they looked at the mortgage spread. And what you find is, and this isn't including 2024. I think this was mid-23 they put this out. I don't know what the time scale is. But when the when you have an inversion in the treasury curve, mortgage spreads do tend to widen. Although, I mean, as you see by the scatter, at 1.5%, 2%, 2.5% yield curve slope, you also see, it extend as well. So I don't know. I mean, if you look at this, and then the other chart you're looking at, Jay, is just the mortgage spread over time. And our audience can't see this. I'll put this in the we post it on ZegaInvestments.com. I'll put these charts in, but not surprisingly, like the spread was right at 3% around the great financial crisis. Do you think anybody wanted to take on a lot of risk? They're like, oh yeah, if I want to buy mortgage bonds, I'm getting paid for it. And right now, people buying mortgage bonds, they want to get paid for it. So, but it's an interesting way of like who's right, who's wrong, which market. I also think the mortgage, when you think about a mortgage bond, and for anyone who's not familiar with a bond, sometimes bonds have what's called a call provision, like a corporate bond. They issue it at 100, and they say, we can call it at 102. So if rates really drop and they're paying a higher coupon, the company can decide to pay off that loan and refinance. It's the same thing with an individual holding a mortgage. So I won't get into convexity, just like we always say, whenever we're going to talk about gamma, or I'm not allowed to talk about gamma. I don't think we can talk about convexity either. But if you think rates are going down, people are like, well, I'm getting paid right now to buy these mortgage bonds because I'm going to have to refinance into something lower when people refinance their loans. It's going to get called away.
Yeah, it's an interesting dynamic because to me, Derek, I think about how many people got loans at these higher rates that would want to refinance. I almost feel like it's the opposite, that people have been holding off on getting new loans because they already did their refinancing when rates were, super low, right? 2.5%, 3.5%. So I maybe on that, Derek, I think we might be in a spot where, I think everybody's been avoiding getting a new mortgage in the range that it's been over the last year and a half. But some people had to, don't get me wrong. But I think the volume it feels, and I think we had done you had done, and we had done a piece on, kind of the average life of a mortgage. And it's kind of like people are riding it out, right? People aren't getting rid of their good deals that they got in 2020 and 2021. So I'm not sure if that'll really pan out the way, that they're thinking. But I would tell you the thing on this chart that you're talking about when you look at this mortgage spread over time, that we are higher really kind of at the levels of the great financial crisis. We're at the levels of right when rates, when there was a pop from the pandemic, we're higher than the rates of like the 01, 02 market sell-off. Mm-hmm. So I don't know, this is definitely an odd dynamic, but to me, it's just the way I interpret it is mortgage rates are being lazy on lowering. So you asked, who do you think is right? The Fed the treasuries are dropping, and I think mortgages are being lazy on dropping it because they didn't make the money they planned on making in the last few years. Sales are down. I know 2 people in town here in Florida that were kind of in the mortgage and refi business. They had to shut their businesses down. There just wasn't enough work. So I think it's just, my feeling is it's just them being a little lazy. They'll have to move them down, but they're going to fight it every way.
Okay. More to come on this. This gets into like textbooky stuff when you get into like duration, and when rates go up, durations extend. Because to your point, Jay, people aren't going to refinance a 3% mortgage or a 4% or a 5%. So they're going to keep that. And then it just gets to when's the natural progression of people moving, downsizing, upsizing, all that type of stuff. When rates go down, durations shorten because everyone refinances. So just think about that. Like if I was lending you money and you were going to be like, oh, I need to borrow money, Derek. And here's the interest rate. Well, if the interest rate goes down by a couple percentage points, you're going to be like, yeah, Derek, thanks for the loan. I'm going to pay you back. And I'm like, wait a second. Now I got to reinvest at 2% instead of, 6.5%.
You're getting paid more. Yep.
Yeah. So I talked to the guys over at State Street about this, and I'll talk to them more. Well, maybe we'll bring on. I've talked about having Mark on at some point, one of their fixed income specialists. All right, let's go to. Oh, one more thing too. We didn't cover this. By the way, Goldman Sachs. Let's say the baseline really is 3%, or it's a negative 1% annualized. Jay, doesn't that mean that there's been some upset over those 10 years? Like, market's not just going to be flat for 10 years. And doesn't that bring up the case for hedging?
Well, sure, of course, right? Because it won't be just 3 for 10 years in a row, right? There's probably, and we know historically the market is up 15% half the time. So let's just say that number gets cut in half, right? So let's say you got 3 years over the next 10 where you're going to have plus 15s. To average the 3, you're going to have some negative years in there. And of course, it makes sense. If that's really what's going to happen, you want to have some protection on. You want to be able to manage the volatility of your portfolio and not, experience all of the down move if it happens.
Yep. But be hedged. If you want to find out more about that, derek.moore@zegainvestments.com. We can walk you through how we do that. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correct. Okay. Meb Faber had put out a tweet, and I didn't think about this, but gold. I don't know if you've seen this. Gold at the time I took this was as of 10/22, up 33.2% year to date. Kind of a good year. The best year
for gold.
That is the best year since I'm looking 1979. Can that be right? 33 year to date. If we ended here. Yeah.
Yeah, that year is up 126%. That seems like a pretty good year.
07 was just under 32. But Meb Faber put out a tweet and he said, tell me a time when gold was up over 25% and the market was up over 25%. And people said, well, 1933, the next graph there. And I think he said his comment was gold was basically illegal to hold in 1933. So he kind of discounted that. And I looked, yeah, gold up 25%. Like 2009 was really close. And again, credit to Meb Faber because I wouldn't even have thought of looking for this. 2009, we were S&P total return plus 25.94. Gold was plus 25.04. That was so. I mean, this year's kind of like 09. Are we just in? I mean, and 2022 was the bad year. So like 09 was the recovery year with a little bad in it.
That's kind of where I was going to go. Like, look, everything kind of had a rough time in 22, and we're in this kind of rebound phase. And same thing with like that 09 right after 08. I know the bottom was in 09, but still, I don't know. It feels like like a lot of asset classes are up this year, right?
Yes,
bonds are up this year, right? Just so it feels a little of like the unwinding of that time period. And so to say it lines up with right after the sell-off of 09, that's yeah. I mean, that's fair. I think it's fair to make that analogy.
Look at the 10-year. Audience obviously can't see this, but I have. This is from NYU Stern School of Business. Aswath Damodaran puts this out. I'll put a link to it, but it's a great resource where you can get bills, bonds, corporate bonds, real estate, gold, and the S&P total return back to like 1928 or 23. Jay, look at 09. I just caught my eye. The 10-year bond was down over 11%, but corporate bonds were plus 20%. All the risk came out of the corporate bonds in 09. But rates went up in 09. So treasuries were down. That's just odd to see that.
Yeah. Yep.
Okay.
Gold good? Good if you were in gold. If you were not, maybe just you buy some from Walmart now. Where's the Walmart impact?
Well, this is your theory that this go. Yeah, you hate when I say it. More buyers than sellers is Walmart and Costco.
In commodities, that's it. Like with gold, that's all there can be.
Yes.
Right? There's no fundamental case for gold. Right? It doesn't produce anything. It's not used in industry. It's an asset that just holds value.
Well, it does, but I mean, don't they use it in circuits, or I don't know? I'm making that
Not
up.
really. No, not circuits.
Not anymore.
I mean, there's some stuff that's gold plated, but it doesn't really have a use. It's not like silver's use. So it is a commodity that is really supply and demand, and more buyers than sellers.
Are central banks buying gold? Is that why it's going up? Are there countries that are buying gold? I don't know.
You know which central bank holds a lot of gold?
Ooh.
Europe. European central banks hold a lot of gold.
Interesting. Why is that?
Yeah. I've asked that question in the past. I do believe it's more of a leftover remnant of, older banks, right? Older economies.
Okay. Well, good for them.
I'm not going to pick on any monarchies or anything there.
We're going to do at the end of the year our predictions for 2025. And I mean, one of the questions on there has got to be, does gold get to 3,000?
That's good. That's a question. I'm not going to answer it yet. I'm not going to give you a hint as to what I'm going to say.
Okay. We'll leave that for that episode. So small caps, who is this that put this out? Who is this? Oh, I took this off Twitter from somebody. Oh, this might be Sam Rowe who had tweeted this out, but I don't know who it's from. This is Small Capitalization Stocks Total Return Index, 13 bull markets since 1949. And if you were looking at this, there's a bunch of squiggly lines because it shows all the bull markets. And the current bull market they have in red. What they're basically saying here, this has been the worst performance of all the 13 bull markets since 1949 of small cap total returns. And so basically, we've had a bull market and small caps have done the worst they've ever done going back to 49 in a bull market this year.
In a bull market. Yeah.
Does that make sense?
Yeah. So they really, so it is
underperformed.
They've underparticipated in the growth during this bull market. They have a lot more potential based off of the historic data that's here. So what do we got here? Like up 25%, right? It goes from 100 to 125. Whereas some of the small cap appreciation, actually, the next one is 150%. I guess this is in number of trading days. Okay, over the next 500 days, the next one is up, maybe that gets to 150%. But some of them are over 200% over that 500-day period. So I think the thing about this chart, Derek, that first struck me is there's definitely a period where you go below the one, right, where you're negative, right?
Mm-hmm.
Days, 200 to 275 is like a decline. So I think, this is definitely unique when it comes to the way small caps have reacted. I think, again, let's go back to interest rates on this, right? It's just, I would like to know the interest rate associated with each one of these bull markets and the small cap appreciation, because I think that has been, a little bit of a weight holding down, the theory is that small caps have a harder time servicing their debt, and when the debt is higher, harder for them to be profitable. So that theory, to me, is the reason why this is underperformed, because we're in this higher rate environment than what we've seen, over the past however many years, 20 years.
You know what this means next year? You're going to see the calls for sell large caps, U.S., by emerging markets, by foreign developed, by small caps. That's going to be the thing you hear in Barron's in like the December issue.
I mean, it's kind of a case we made. Well, we didn't say sell large caps, but it's a case we made about, hey, there is a lot of upside. It looks like there's the potential for upside on small caps just by the projected earnings numbers that we took a look at. So I don't know, last week it was pretty compelling to me.
Not only and I hope people realize the impact of rates, and kind of drilling down on that for a sec. Not only do small companies have less access to the rates that large companies. In other words, if Apple wants to borrow money, they almost set the price. But if a small cap company wants to borrow, they're not going to get as good of a deal as large caps, and they're more levered. They're more, they have more debt. So if interest rates do come down and they can refinance, or maybe their revolving loans or drop their payments, like all of a sudden their earnings potentially could be a lot more. Or you could have companies not making money to make money. All else being equal, I mean, who knows, right? Who knows what happens?
Yeah, of course.
But that's kind of and then, you brought up there's certain industries or that might be better with one presidential candidate versus another. I guess not a candidate, one president versus another. That's the other thing. So, okay. Also, Sam Rowe had put this out on Twitter. This is from Goldman as well. 36% of S&P 500 constituents turn over during the typical 10-year period. And this is 10-year chart of 10-year turnover of the S&P members. The average is 36% over a 10-year period. What that means is...
When you say turnover of constituents, help everybody understand what that is.
So we think about the S&P 500 has, a little over 500 companies in the index because, Google has 2 of them. But anyway, let's just pretend that there's 500 in there. Of the 500, every year, some companies get kicked out of the index. Other companies come in. We talked about Bath and Beyond, or whatever the heck that company is. And we talked about that a couple weeks ago.
We did.
So new companies come in. Let's say that Apple bought, or NVIDIA bought Coca-Cola. Okay, those are 2 constituents, 2 members of the S&P. Once that finalizes that, why would NVIDIA buy Coca-Cola? I have no idea. But they merge, and then that's one company. You got to bring in a new company in that. Companies, become bankrupt and go out of business. They're coming out of the industry. So that's what I mean, Jay. That's what this is referring to.
Okay, so on average, this says over 10 years, 36% of the constituents change.
That's right.
For over a 10-year period. Yeah. I mean, so what do you want to say? 3-4% a year is kind of the turnover, if you math there. But right now we're running lower. I don't know if that's a good or a bad thing. I don't get it. Like, what am I supposed to? Is it good that there's been low turnover? I would think so.
I didn't even care about that. I found this interesting because you and I have done several episodes where I've talked about the underappreciated nature of constituents coming in. Remember, I always talk about the EPS and how all the earnings are aggregated.
Yes.
If you kick out the weak companies and you bring in stronger companies, in theory, it should help be a wind at the sails of the S&P. And I won't link to the episodes because we've probably done this 10 times. I can't remember which ones are which, but we've talked about this. And I know I care about it. Not a lot of people do. I always bring it up. I look at when a company comes in, what's the new company's revenue? What's their earnings versus the old company? It fascinates me and it's underappreciated. So
do you think it's bullish as new companies come in and the weak companies get pushed out versus the companies that are in there stayed strong enough to not get kicked out?
I think it's both. If the company is strong enough to not get kicked out, that shows strength. It also, it could be M&A. And with M&A, you usually get economies of scale and you get different things, different accretion benefits to the bottom line. So it could be any number of reasons, but I don't know. I mean, but you look at from 2000 to 2008, that was the other tech boom. And think about all the technology companies that came in there. We have the companies for AI are all the big tech cap companies that are benefiting from that are tradable. Like, we don't hear about you remember, Jay, in 2000, we heard about some little rinky-dink company that was going to, have the new browser. And all of a sudden they were trading at 1,000 times future earnings. We don't have those today. Like, there's not a lot of talk on CNBC about, this is really a specialized company, right? So I just think it's different today. But that's why we saw the rise. Well, the audience can't see this chart, but from 2000 to 2008, there was a lot more turnover.
Okay.
I mean,
I don't see a particular pattern on it.
I'm not saying there's a pattern. I'm just telling you I'm backing up what I've been telling you. I'm telling the audience, this stuff matters. Like, no one talks about this. So
but I'm trying to equate it to how it changes or how people can make investing decisions based off.
They can't make any decisions. I'm just telling you, that's why you buy an index, because it's going to weight the stronger companies. It's going to theory, and it's going to self-fulfilling, it's going to morph and change. And, if you're buying the NDX or the Qs in March of 2000, you had Sirius Satellite Radio as the number one weighted company. That's it.
Got it. All right.
Let's see. What did we miss? Jay, you had something else, didn't you?
Well, I mean, we hit on a lot of the stuff that I wanted to talk about last week. Earnings are coming up. We've got a lot of big names on the way, I believe, right? You like to talk about what's on the way. We could even dig in a little, if you want, into maybe some of the bigger names that are coming.
Well,
but
you shouldn't bear the lead. I mean, next week, it's the big ones.
The big ones, yeah, the big tech companies, right? So,
Apple,
what do we got?
Google, everybody but NVIDIA, right?
That's right. We had Tesla this week, which market liked the numbers out of Tesla. Clearly, had I think its best day yesterday, being Thursday the 24th, in something like since 2013, right, up over 20%. So we shall see if that follows through with right. We got Google, you got Meta, you got Apple, Microsoft is in there. Who else is coming in there? This is just a handful of other ones too. So I would say this is typically, I think we've talked about this before. Historically, market is a little hesitant going into those numbers, and then you have these numbers. It's interesting, right? For just the way the timing works out, but you have all of these right before the election, and then you have the Fed meeting right after the election. So lots of opportunity for market volatility. I think that's why we are seeing the volatility indicators, hovering a little higher than normal, but this is very normal stuff. So,
do you know who's next Thursday before the market? I know you're waiting with bated breath. Sirius XM satellite. What is that stock trading at?
I think they did a reverse split. I think it's in the 30s now or 40s or something like that. I could take a look at it. But
I have no idea their financials. I haven't looked in years, but it's still fascinating that was the highest.
I still pay for it in multiple vehicles.
Oh, you're the one.
It looks like reverse split in September is trading at $26. We've had a client that's held it since then, by the way. So he and I joke about it. I think he's just always going to hold his shares forever. But this is it's one of those things that you just don't know where that one's going to go. But I don't know. It feels like utility. Why they haven't been able to figure that out after all these years? Like, what is their? Well,
I'll tell you what's happened. It's people now can run Spotify in their cars.
They totally can. And it's, I saw a funny meme. It was, this is why you and I are, Gen X, right? We're Gen Xers.
Yeah.
We have gone from getting our music when we were, in elementary school on albums to tapes to CDs to MP3 players to Sirius Radio, and now you've got Spotify playlists. Like, it has just been an interesting evolution of music access. So, that's what's going on with them. I've always thought they missed the mark on the ability to sell, songs while you're playing them. Like, you hear a song, you're like, wow, that'd be great. Let me download it to my playlist, right? Now you use Shazam and you just, add it to your playlist later. But, I always thought years ago when you were paying for, music on Apple Play or wherever by the song, felt like they missed the boat on that.
There's an app I think you can actually hum or sing a song, and it can figure out which one
Google
it is.
Tried to do that, right? I've never seen it was on one of the phones that they allowed you to do that, but well, Shazam works just fine.
But
have you used Shazam?
I've used it. I have it on my phone. Yeah, I'm always like, oh, what is that? Yeah. Well, it goes to, remember you talked about being at the conference and somebody asking you, what's going to cause the market to go down? If, when Sirius XM and when Sirius and XM merge, you think, oh, they're cornering the market. I can't believe they're letting this through. But it wasn't like Spotify wasn't a thing. Pandora Music, Apple Music. Like, that's not what really got them, I mean, if you pay for XM right now, or Sirius, whatever it's called, you're like, oh, I have to have Howard Stern, or or you just like it in the car. If you're driving in the middle of nowhere, you have it. So
I use it for CNB and Bloomberg wherever I'm driving. Right there, you go.
Right,
that's not on a playlist. Yeah,
you could do that on your phone.
Yeah, Yeah, I could. You're right. I could play it on my phone. Then I got to Bluetooth my phone to my car, but which I probably do anyway automatically. But just easier to hit the button.
I get it. But you're the guy still paying for Sirius satellite radio and getting 0.01% at the bank. So that's.
Wait, do you not have Sirius in any of your cars?
I used to have it.
All right. And that old Jeep you got?
Yeah.
You got rid of it?
No, I got rid of it. I was like, it was funny too, because I kept trying to cancel it, and they'd be like, well, just give us like $3 a month. I'd be like, okay, I'll keep it for that. You know, I don't know how you're making money off me, but okay.
That's it. That's why the stock needed a reverse split, I guess.
Probably. So I'm just looking at the earnings. So I think you mentioned, AMD, that's the next semi. Of course, NVIDIA, I think, is mid-November, I think they'll probably come out. But there's, like, is that going to be interesting to people?
Sure.
That's a high volatility stock, right?
Yeah,
that's
of course.
That's one. It's Amazon, Intel. Intel to me is the interesting one. Like, what do they do? Do they just sell off pieces? Do they just, I don't know what they do.
Talk about a fallen angel, right? Like, wow. So, but yet they still kind of qualifying to get money for government foundries, although they haven't. We talked about that in a different show.
Yeah.
Right. So
I just want the under over on when they get kicked out of the Dow.
I can't believe they're still in it.
Look at the weighting, isn't it? Didn't we look at it? It's like less than 1%. I could be wrong.
Like 0.3%, something like that.
Okay.
It's super small.
All right.
Palantir, no, that's not next week. I think that's the week after. That's become a very popular stock, right? You hear about that one every day now. I think the price is, I was like, what do they do? Software? What's that mean? But it seems to be, that they're getting more involved in, institutional servicing and those kinds of things. But interesting one to watch as that is coming up as well.
Let's look at Apple's IV. I haven't looked at this, Jay. So we got earnings next week. What is it, Thursday? We always kind of like to do a little
I've got 10/31 as the date for.
So there happens to be a November 1st option.
There you go. That is Halloween Thursday. You got it.
So close today, 231.41. So what's the closest it's right in the middle with the strikes, isn't it?
Yeah. So it's got like a 30. That week's got like a 34 IV. What are you looking at, the straddle, like the break-even price according to the options?
Yeah, like if you bought the 230 put and bought the 232.5 call, you probably have to split this one because there's not a.
Because it's right at 231. I gotcha.
Yeah.
So I don't know. Looks like projected, but you could add the two up. It's like $9? About a $9 move. It's projected in. If either you could look at the 230s or the 232 halves, Derek. It's about a $9 projected move right now between now and then. So we don't know if that's not the day of, but $9.
Yeah, I mean, the IV is, the implied volatility is just around, 33, 35, about 34 across that month, that expiration.
Yeah,
not that much, actually.
It's really, but even at a 34, 35 vol to have a $9, which is what, almost a 4% move.
Mm-hmm.
It seems, not that much. I'm not going to use the word cheap or inexpensive. I bet that probably starts to expand as we get closer.
Yeah, that's
go up. Yeah.
And by the way, it's an interesting lesson too, because you might hear us say it's cheap or expensive. We bring this up because it's a 50-50, whether they beat earnings, don't beat earnings, do something great, don't do something great. And what happens is when people start trading options, they say, oh, this is easy money. I know it's going to move. I'll buy a put. I'll buy a call. Well, the market knows that. It's priced in. What we're talking about, though, Jay, for the audience is like how much of a move is actually priced in. And we look at what's called the implied volatility. And that's the implied, let's say, forward move over the next, X number of days. And we bring it back to today. So, yeah, I would agree. It's not really that much. It's not much implied volatility baked in. Like that seems low. That's only about a little over 2% estimated daily one standard deviation move right now. So
seems low. Well, we'll see.
Well,
we shall see.
Well, that's the thing, right? Some people say, well, I'll sell the straddle. I'll sell the put, sell the call. And other people say, I'll buy it. And I'll let you know which one works after we know. I mean, that's...
Yeah. So if you wanted to just kind of play the move in Apple, right, your break evens are up and down $9 from here. So 222 to 240. It would have to go outside for that straddle to make you money.
Uber's probably got... Yeah, Uber has more vol. If you look at the November for Uber, closed 77.62. What do we got? So, say the 78s are probably the closest.
Yep.
Yeah, 65% right there. That's it.
Yeah, so stock trading at $77, $78. The break even is about $6 move. So, yeah. But its implied volatility is at 64, so it's double Apple's implied volatility. So
that's right.
Makes more sense.
64.
Historically speaking, though, you could track what the implied volatility looks like versus what it has before, right? So that's something you could see. Right now, leading into earnings, this is low for Uber. So with the IV, somewhere. I gave that 1 day, but the 30-day implied volatility is in the 40s. In the past, around earnings, it's been 60. Look at this one here. Going into it was 50. Yeah, so this one's a little cheaper compared to maybe the last, 3 out of the last 4. The implied volatility was higher, meaning option prices were higher those other times. So, and it was still in an uptrend. Like it's been, right? I mean, this stock has gone from a year ago, 42, up to today at 77. So it's moving up, and vol's a little lower than expected. So maybe the market thinks it's going to hold. Who knows? I don't know how to interpret that directionally, but we could say options are costing you a little less this time around. Now, we're still, a couple days away. You really got to watch on, Tuesday, Wednesday.
Does Uber matter in the economy? Maybe is it a bellwether? If people are...
Well, for sure. I think it matters more than Lyft. We know that just because they have a little wider gap. I mean, I don't know. Have you ever ordered Uber Eats? You ever get any food from them? I love doing that when I'm on the road. Instead of trying to figure out how I got to get out from a hotel and find something, by Uber Eats to my hotel all the time.
I just hate don't look at the fees. Just be happy about the food you're getting. Don't look at the fees.
Well, that's the thing. Yeah. Like if you're hungry, you're like, I don't care. I'm in a different weird city. Just bring me some food. Oh, that Taco Bell just cost me $40. Okay. Not that I'm eating Taco Bell every night, Derek. Don't worry. It's not happening that way.
Can I tell you, a friend of mine started a food delivery service before the internet. He did it after college, and they were like, oh, wouldn't it be great to be able to just order something besides pizza? They had like the telephone book maps where, A5 and you find like Maple Street, you got to find it. And like, I think CB's. And they went to the restaurants and said, we'll deliver it. You'll get all these different orders, but you can't charge more.
How's that got to work?
And they took 1%. And they make it up on volume. But anyway, it's just interesting. He
was early.
Oh, he's very early. Yeah. It's like, he's the same type of person who would, create Netflix in the 50s. Like, I think this is going to work, smart guy, but it is really interesting. And, I'll tell you more about it offline.
Earnings are going to be fun though. This is the week coming up. So
it's going to be good. And I feel like this week we had a void in the economic data. Next week, it's, I think we got some other stuff next week, but
PCE, is that coming?
I mean, does it matter? I think it matters, right?
Yeah, that's the inflationary mark that the Fed uses, not CPI, which comes out much earlier in the month. But yeah, I think we got that coming next week. But it's the earnings of the story.
Earnings of the story, and the election.
And the election and Fed right after that.
That's right. You're not joining us for our election preview, right? So I'm going to do that with Spencer Wright. We'll have our regular show next week, but Spencer and I are going to record a segment as well where we give our picks and look at the analysis.
Spencer loves that stuff. That's great.
Yeah. So we'll do our show, and then it will be the same download, but then we'll package that at the end of it And we have some good stuff coming for that, like looking at the polling numbers and the data. There's a potential for a tie, by the way. Did you know that?
I did not know. I'll have to listen into your podcast.
Yes, I'm not going to tell it. You got to listen next week. You should listen this week too, obviously. Well, if they're listening to it.
You are.
Yeah. Well, keep listening. But yeah, next week could you imagine that? I'm not going to tell you what happens if they tie. There's a process for that.
Let's save it. Cliffhanger.
All right. Anything that you've been watching? So this is. By the way, somebody else said it. We stole this from. There's another podcast. I said absolutely from Barry Ritholtz, Masters on was it Masters on Money on Bloomberg? He would always ask, "What are you reading, writing, or watching?" So absolutely, I took that from Barry. So.
We started watching and listening to Barry a long time ago. So I got nothing this week. Sorry, been on the road, been a little busy. So I don't even know what I've planned to watch, but it is Halloween coming up, so I'm sure it'll be spooky.
Our audience was like, they feel like we haven't been giving him as good of recommendations lately. They did.
Well, I've been a little busy, Derek. I'm going to work on it, though. You got it.
Yeah. One of our a friend of the program, Michael, he keeps telling me I need to watch Slow Horses on Apple TV.
Yeah, not bad. So not bad. Spy show. Gary Oldman does a great job of this like grumpy old super experienced spy he's in like kind of in the doghouse group, like, oh yeah, go over there, right? They're the slow horses. But they end up, always coming through, and it's kind of a raggedy group. The first scene, I think, even just getting into like wherever their little building is, right? Their MI6, MI5, MI6, their spy organization in UK. They like the door doesn't even work. The front door doesn't even work. You got to kick it in. It's just they're just like they have all the worst stuff. They get the garbage jobs. So, but it's good. I have not seen the most recent season. I've seen the previous 3. I think they're on 4. It's on Apple. Slow Horses it's good.
Yeah. Well, what I like about watching a series that's been out for a while is I don't have to wait, week after week to get the new episode. So I can just binge a bunch. So I did watch Wolves. That's Brad Pitt and Clooney.
I thought that was good. Yeah, I guess I did watch stuff. I just forget to write it down. But yeah, I thought it was good. Did you like the ending?
I did actually.
I think they make it out.
Don't ruin it. Don't ruin it for people.
I'm just asking if you think they make it out.
I think so.
I think they do.
I think so.
Yeah.
That's a movie where a lot of people might watch it and they feel like it was more of like a thinking movie. Like it was almost like a Tarantino movie to me.
Almost.
I thought it was okay. It's not a strong buy. It's a market weight.
Market weight. You got it.
All right, Jay. Also, World Series. I don't know if you're aware of this. The New York Yankees, the greatest team in history. 41st, I believe, World Series appearance. They're going for number 28.
Against the Dodgers, I hear.
Yeah, I don't know if you saw in the Wall Street Journal, somebody wrote a piece, could this save baseball?
I thought, right, because you get the 2 big cities, competing. Yeah, maybe.
He mentioned that in 1977, New York Yankees, Los Angeles Dodgers, 44 million people or 44 million households watched that. That is a huge number.
That's a huge number. I heard tickets are going for an astronomical amount. I think I heard second market, $3,000 a ticket. For a baseball game.
Well, I mean,
there's more than one, right? Like you got to have at least 4, maybe 5, 6, 7. So I don't know. There you go.
I went to Game 3 last year when it was here, when the D-backs played the Rangers. And it was great. You don't get to see a World Series game.
$3,000 a ticket?
I did not.
Oh,
I did not.
Strange.
I think I wound up getting. They knew some people had the lanyards that said part owner, and they were like, "We'll sell you a ticket, but you can't like." Anyway, it's.
Feels like something you should.
They weren't supposed to sell a ticket, but I went down and I got a ticket. So, and I sat 10 rows up from the dugout.
That sounds amazing.
Yeah, no, it was great. It was great to see a World Series game. Baseball's great. The pitch clock is great. Yankees probably win the series 152-0. That's my prediction.
That's it.
And their winning game, we're recording this on the Friday. I think they'll win 87-0 tonight. That's mine.
87. Okay.
87. I know it's a bit.
I might take the under on that one.
It's a bit aggressive, but I think that's the way it's going to work out.
Greatest team in baseball history, as you said.
Number 28. It's hard to be humble when you've won this much. All right, that's it, Jay. That's
Bye
it.
to our Boston Red Sox fans.
Well, I mean, we have to have 2 T-shirts to put all our trophies on. They only need 1. And we'll be back next week to talk about the election. That will be our big election show, as well as we'll have a lot of earnings and other stuff there. Jay, thanks again for coming on.
Bye, Derek.
See you, everyone.